Welcome everybody to our market update. So it's been kind of an exciting last 3 or 4 weeks. It's great to be with you all. Most of you have probably been keeping up on our market update events that we do. We do these webinars the last Friday of every month about different topics. It just depends on kind of who's presenting and what we're going to be talking about. So today, let's dive into it here a little bit. Let me jump back into PowerPoint. We'll jump, hopefully, there we go. A little information about me. For those of you who don't know me, I think everyone on the call pretty much does know me, so I'm just going to jump right over that. Here's our agenda today. So the things that we'd like to talk about. The first thing, we're going to cover what happened in August so far. I know that we're not quite done with the month yet, but we're going to look at the month in review to see kind of how things shaped up in the markets, what big indicators there were, what's going on. We're gonna then dive into some of the meat and potatoes of what we had discussed here, the rules for portfolio construction. So we're gonna learn a little bit more about style boxes, what a style box is and what that means, how we can go through and read that. We're gonna understand a little bit more about concentration and then how we can protect downside, or maybe more importantly, how managers can protect downside for us. We're also going to use another resource. Most of you are probably familiar with Yahoo Finance. We use that all the time, but we're going to introduce a new resource to you today, an organization called Morningstar. Some of you may be familiar with it, but for those of you who aren't, it can be a very, very powerful tool to understand some of what we're talking about here today. And then finally, we're going to open it up for questions. If you have any specific questions you'd like to address, we'd be more than happy to take a moment to talk about those. So let's talk about what's going on here. I got Mr. Jay Powell to sit with me here. Interesting time in the market. So first off, let's talk about what the markets did in August. Looking at the S&P 500 and the NASDAQ, they were both up somewhere in the neighborhood of 2 to 3%. So it was a good level of growth for the markets. The Dow lagged a little bit behind. We were sitting at about a 1% growth so far for the month of August. What plays into that though? What's very interesting is we're starting to see very wild volatility again. So some of you may have been paying attention through the middle of the month. There was a really bad, probably 6 or 7 days in the market where we saw pretty consistent losses all the way through. The NASDAQ at one point through the month of August was down 1.5%. So that growth that we've seen didn't come without a little bit of volatility as well, a little bit of turning in the stomachs. It's been pointed, I mean, there are a lot of different things that play into that. What's really interesting about kind of what we're seeing with that increased volatility, COVID is less and less of a concern. Now the Delta variant and everything like that that's coming out, that's kind of interesting to see how that's playing in. I'm going to mute here, hold on, just here, there we go. It's interesting to see how the markets are responding to that. Ultimately, I don't think that it's as much of a concern as it was previously, which is good. We're learning and we're growing. The markets are adapting to what's going on real time. But what definitely is playing into a lot of the positive growth are these corporate earnings. So over the first 6 months of the year so far, we've seen it's like 260 companies up to this point have reported earnings. And for one of the first times in history, 91% of those 260 companies have exceeded their expectations. They've beat their earnings. Now, a lot of that is pent-up demand. So we've seen a lot of people running out into the markets and buying products and using services and doing all kinds of good things. But to see that kind of incredible growth, it's phenomenal. And that's definitely what's supporting the markets. Good, strong corporate earnings right now. We're just blowing up left and right, which is fantastic. We kind of anticipate that to slow down a little bit through the end of the year, but who knows? I mean, with all of the momentum we've seen going up to this point, earnings could continue to smash how the markets are doing, how we expect corporate earnings to continue. Now, also infrastructure, we've done a lot of discussions on taxes here recently. Infrastructure spending is definitely on the rise right now. House earlier this week passed the $3.5 trillion stimulus package that includes all kinds of different things built into it. What effects is that going to have on the markets? It looks like money is going to be relatively easy to get. And with a few new programs and things like that rolling out, it might give for a little bit more flexibility. Anytime the government tends to spend a little bit more, certain industries will spike. We'll see definite high levels of growth. Now, here's the most important thing that I think that's going on. The Federal Reserve, as we sit here right now, the Federal Reserve is meeting in Jackson Hole. They're sitting down and discussing kind of what is going to happen in the future. And Jerome Powell, the Federal Reserve Board chair, he's kind of like the big time banker of the United States right now. He is kind of leaking out certain goals and certain ideas that the Federal Reserve is going to be trying to move forward for the next quarter, 2 quarters, 3 quarters, 4 quarters, and into the next like 5 or 6 years. Now, what's interesting about this is Jay Powell came out today and said that their slowing stimulus spending could have a very negative effect on the markets and the economy as a whole. But what's really interesting is, for those of you who are paying attention, a couple of weeks ago, Eric Rosengren, who is the Federal Reserve Board chair in Boston, came out and said that it's time to start slowing stimulus. So already we're seeing there's some dissent with the Federal Reserve. It's going to be interesting to see what the Federal Reserve minutes of their meeting right now will look like, and ultimately how that's going to play out. Now, if stimulus continues, if interest rates stay low, that's usually a good thing for the markets because money is easy to get. Corporations tend to do well in these times. The threat is what happens with inflation. So the last bullet point that I wanted to address for this monthly market update is consumer price index. What is inflation doing? We were very concerned about this at the beginning of the year. Consumer price index spiked very, very quickly to one of the highest levels in the last decade. It's kind of paired off a little bit. It's not as bad as it was looking. The consumer price index, based off of the last time I checked, was sitting at like 5.1 or 5.2%, which means we've seen inflation, and we've seen inflation higher than over the last, decade, 15 years. But it's not as crazy out of control as we thought it would be. We're not hitting any kind of like double digit or hyperinflation, which is good. The Federal Reserve has been able to curb our concerns about that consumer price index spike, all while keeping things kind of status quo with the markets and with the economy still recovering from COVID and everything else that happened last year. So kind of an interesting take on what's going on. We don't really know what's going to happen into the future. And what's interesting is nobody really knows what's going to happen in the future. So some of what we're going to talk about today, the remaining 10 or 15 minutes of discussion that we have, are going to be more of how you can address that market volatility. I guess that's not true. I do know what's going to happen in the future. The markets are going to be volatile. They've always been volatile. They'll always be volatile. So what can we do to help reduce that volatility? It all comes down to portfolio construction. You need to make sure that your assets are being allocated the way that you want them to be allocated, and that you're not taking too much risk based off of your own personal risk tolerance. So last month, I'm going to dive into the next discussion here, the different rules that we're going to talk about. Last month and the month before, we talked about 4 other topics. So Lynn talked about overlap and commingling, why we don't want overlap and why we should avoid commingling of assets, commingling of investments. The month before that, in the month of May, Brandon did a fantastic job talking about active share and why we want active share involved in our portfolios, as well as turnover, trying to avoid turnover as much as possible. We're going to cover 3 more rules today. We call these the 7 deadly sins. So we've talked about 4 already. We have 3 more to go. Rule number 1 is understanding style boxes. So overlapping styles and holdings, even among managers, can lead to closet indexing. We really don't want to be closet indexers. It doesn't make sense to be a closet indexer because ultimately you could just go and buy the index. You'll pay less of a fee. You'll get less of the return. The key here is that we want better management. We want higher quality management. And that can be found by understanding these style boxes a little bit better. So closet indexing, increased cost, both of those can reduce overall returns. So let's talk about what a style box is. Some of you may have seen this before. Some of you may be very familiar with style boxes. That's great. If you're not, here's kind of a good way to understand how these things work. So back in the olden days, I'm gonna grab my pen here. Back in the olden days, they only focused on these internal 9 boxes. This focuses on large, mid, and small cap investing. So a large company, these are companies usually worth like $10 billion in revenue or more a year. We've seen that's been kind of debated a little bit, and we've seen these new giant corporations come out. Sometimes these are referred to as mega cap corporations. Mid caps, kind of as it sounds, they're not as big as the large guys, but they're not as small as the small guys. These are kind of the middle of the road organizations. One that I usually will refer to is O'Reilly's, the auto parts store. Most people are familiar with O'Reilly's. They got retail stores all over the country. They fall into the mid cap category. And then small cap are the up and coming companies. These are the ones that are like tiny, that have just gone public, and you know, they don't have huge market capitalizations, but they have high potential for growth. This is also broken down, this 9-box schedule that I kind of outlined here, by value, blend, and growth. There are certain indicators that determine whether a company is a value company or a growth company or somewhere in between. And so managers will look at these charts and try to determine, okay, based off of what I want to be investing in, these are the companies that I need to look for. Now, what's interesting is we also have micro cap companies. These are like the smallest of the small. These are tiny organizations that trade publicly. They also kind of fall into this. And the box has been extended now. So we have what's considered deep value. We have what's considered high growth. And what's interesting about this is every organization will try to identify where they are on this box. Now, without telling you anything, looking at this heat box, let me erase kind of some of what I've got here. This is a real mutual fund. How would you anticipate this mutual fund deems itself? Well, you can see right here, this little red circle says this is how the box identifies, okay? They identify as a large cap growth allocation. Now, what's crazy about this, how many of their holdings are actually in large cap growth? How many of them are in this little box right here? Not many. They kind of have this wide smattering. So you'll usually see on a style box, you'll see a circle that tries to capture the majority within one standard deviation, the majority of the positions that they're holding. What's interesting about this position is this style box would have a circle kind of like that, which means this thing is all over the map. It is everywhere. And if you can see, I know it's kind of small, but these different numbers are the number of securities that are within this specific position. So we'll talk about concentration here in just a second. But if we're holding 140 different stocks, man, that is kind of, that's a little heavy. I don't think that you need that many stocks in a portfolio. Now, we want to make sure that we're diversified, yes, but man, that seems like a lot. This turns into closet indexing. We have to be very, very careful about that. So just some statistics that I want to break down with this style. Only a third of those companies are considered large cap growth that are held within this specific mutual fund. You can see the breakdown. It's holding 19.3% small cap value, which I think is just insane that a large cap growth allocation is holding small cap value. That's the opposite end of the spectrum here. On top of that, of all large cap, I mean, in this box right here, 2/3, they have a third of their allocations that fall outside of large cap positions, which is crazy to me. And on top of that, the plurality is in growth oriented. A plurality is in this box right here. But I mean, if you look at value and core, we're not even holding a majority share in growth. So it's important to understand how these style boxes work, and with your own specific investments to determine, okay, given our style box, this is kind of what we expect. Now, take a look at this. That's the same large cap growth from previous. We also have a large cap value position. Holy cow, large cap value, it's all over the map. Look at that target circle that one would be focusing on. It's everywhere. Large cap core, which should be focusing primarily in this box right here. I mean, you can see that's kind of all over the map as well. So it's very, very important to understand what these specific style boxes are telling us. Also important to realize that the average active managed mutual fund is holding 437 different holdings. My goodness, there are only like 490 stocks on the S&P 500. We're practically an index fund like that. So big. I mean, there's so many different holdings. What are we even doing there? Might as well just join the index and at least we're getting the performance. It's important because each one of these portfolios that have this significant amount of box breakdown, we'll call it, this mess that we're facing, significant overlap, we have this hyper diversification. Hyper diversification is not a good thing. We want uncorrelated diversification, which is an important piece we'll talk about here in just a second, but hyper diversification does you no good. We have huge amounts of redundancy. We, depending on the tax qualification, you could have, some pretty significant tax liabilities, and of course, increased transaction costs, not just your expense ratios, but the turnover ratios that Brandon talked about a couple of months ago. Ouch, that can be a very expensive thing. So what do we suggest instead? One of the managers that we use a lot of the times, actually, I see it, we have a handful of clients on here as well today. We use Poland with a lot of our client portfolios, and take a look at their style box. So we've got 75% of their allocations are truly in large cap growth. They are a focused growth manager, which means that we allow them to have a little bit of mid cap growth as well. The whole reason we've got these is we want growth allocations. They are hyper focused, they are semi-concentrated, and they have a very high active share, which is what you want to look for in proper portfolio management. And taking that a step further, we have some other managers like Logan Capital, like Congress, like Kane Anderson. Using all of these together, let's just say that we took and built this model portfolio and allocated it between Logan and Congress and Poland and Kane Anderson. Using all four of those, that would mean that you have 98 total stocks, 0 overlap. And take a look at those style boxes. You can see we're very focused. We're hyper focused in this stuff. Now we're going to look at real time here in just a second, but every fund manager will report their style box. So if you're looking for it, type in whatever fund manager you're using and see if you can find their prospectus or their annual report. More than likely that style box will be included there. Now let's look into rule 2 here. Let's keep moving forward here. Concentration. And I don't mean like the concentrate kind of concentration. We want concentration of our stocks. When we invest in something that is large cap growth, we should be concentrated in large cap growth. We should be avoiding as much as we can elsewhere. We don't want that huge amount of overlap. And what's interesting is we really try and focus on 40 to 50 holdings. If you got more than 40 to 50 holdings, you're kind of creeping into that closet index arena. We don't want that. We want to avoid closet indexing. What's interesting is concentrated equity managers looking over certain periods, 3 and 5 year rolling periods, will typically return better than diversified managers and better than the index. So as long as you're using a good manager that has high quality, your performance typically will be better. Looking at 1999 to 2014, averages on concentrated managers have improved over diversified and S&P 500 index managers. And more importantly, we don't take as much risk. So this chart tracks what's called downside capture. And you'll notice the fewer positions that we have, the fewer stocks that we hold, the less volatile, the less loss we realize. That's kind of an interesting thought. Our whole lives, we think, no, we need more and more and more. We need diversification. We need a lot of different positions to reduce the amount of risk that we take. When it comes to equity management, though, the fewer positions that you hold, as long as those positions are considered high quality, and as long as you're working with a good fund manager, your performance will actually improve and your drawdown will reduce compared to those who are closet indexers holding more than 250 funds. Very interesting to see how that plays out. And that plays into our third rule. We need to protect from our downside exposure. We can't be exposing ourselves too much to risk. And especially when it comes into these equity managers, there are ways and strategies that you can utilize, strategies that you can implement that will reduce your downside capture. Now, I want to just address this real quick. Let's say that we had 2 portfolios. They had the same annual average return. We know that these numbers can be very deceptive. So here's kind of a real absolute versus relative return. We have 2 investments. Investment A here is this orange color, down 8% in its first year, up 18, down 40, up 37, up 28. If you do the math on that, that average is 7% a year, 7% return a year. We have the same average rate of return with the red line. So down 3, not quite down as much. We don't capture as much of that downside. Up 13, we also don't capture all of that upside. Down 14, thank goodness we avoided that. Up 22, up 17. We're never performing as well as the orange fund is. But what's interesting, that's also an average of 7% a year. But looking at the absolute returns, red fund did 1.3 million, $1 million invested turned into 1.34 million, whereas the relative orange investment only returned us 1.1. Losses will kill portfolios. Anyone who's talked to us for more than 10 minutes knows that losses kill portfolios. We have to be very, very careful to limit the downside exposure that we have. It's better to maintain portfolios with high levels of consistency that don't have as much downside capture than it is to try and capture these guys that have the wild, crazy upswings, the double-digit crazy returns. We want to capture some of those. We may not earn quite as much, but the key here is to limit in bad years, be defensive in bad years and opportunistic in good years. Here's another kind of a breakdown of what this might look like. So this is a portfolio that only has 90% downside capture, meaning when the markets are down 50, this is down 45. It's not like it's that crazy, but look at how much better the portfolio does. This is over a lifetime, going from 1925 to 2014. $10,000 invested turns into 62.6 million compared to 53.9 million. Those losses will kill portfolios. If we can avoid the market downside capture, that's where we really start to excel. Now, we're just about to wrap up here. I want to share with you one other resource that we use. Let's see. So Morningstar, they have a paid membership that you can use. You don't have to use it. Everything I'm going to be showing you is on their free side. So you can start to see style boxes. I'm going to start over here with, let's look at Poland's mutual fund. So here's our style box. We can see exactly how this allocates, and that ring around keeps us focused. We want a smaller, tighter ring. What's interesting on this is if you type in the ticker symbol here, you can scroll down to the bottom and see all kinds of information. One thing that we want to focus on, though, again, with concentration, we don't want a huge amount of managers. This specific position is holding 24 stocks. If you want to break down what those stocks are, boom, there they all are. Some of you have probably heard that I love T. Rowe Price. The T. Rowe Price Large Cap Growth is, in my opinion, one of the best mutual funds that's out there, widely used in 401ks. Again, another tight circle here. That's kind of what we want, a little bit wider than what Poland was, which means it's going to have a little bit more overlap, a little bit more turnover, a little bit more fees. Not quite as good as Poland in this case. And what's interesting about this is if we look at the holdings, we scroll all the way down here, it has 69 holdings. So it's eclipsing those levels that we're kind of comfortable with. We're starting to get into the closet indexing. We have American funds. I just have a couple that I preloaded here. Look, the circle's getting bigger. Circle's getting wider. These are all large cap growth funds that we've been looking at so far, but so far we're seeing that not all funds are managed the same way. Scroll down here and we can find, holy cow, this fund is holding 404 different stocks. That's an index fund. Why in the world are we paying American funds or Edward Jones or whoever this management fee to get something that pretty much can be got by the index? And the worst part about this is this one doesn't even perform that well. The American Growth Fund of America underperforms the S&P 500. So what are we doing? I've got Vanguard here. I don't want to pick on anybody. I'm picking on American funds here, but I mean, we can take a look at everything here. The Wellington, one of the most common funds, you can see it's supposed to be a large cap blend. It's getting a little bit bigger. This position, this Vanguard fund is holding only 68. So it's not too bad, but again, it just has to match what our risk tolerance is. A lot of people are holding these target date retirement funds. We are not a fan of these things. It looks like it's pretty well focused. The problem with this is internally they're holding, you can see 0 equities. The reason why that's showing as 0 equities is because they're holding a whole bunch of other mutual funds. This is a fund of funds. We don't have time to get into it, but honestly, fund of funds are just awful. You want to avoid those like the plague. Now, a lot of people say, hey, Gage, yeah, we know all about mutual funds, but you frequently say that mutual funds aren't as good as exchange traded funds. The cool part about Morningstar is you can also look at exchange traded funds. If you have an exchange traded fund that you're invested in, or an ETF for short, they also have heat boxes. They also have breakdowns of how many holdings that they're in. You can see specifically what ETFs, mutual funds, any of that stuff. You can start to develop this yourself. Now, we believe very much in education. That's the whole reason for this outreach today. Hopefully you learned a little bit more about what these positions look like. We would love to encourage you, for those of you who are watching this on YouTube right now after the fact, I'm saying right now, this is weird. We're kind of getting into like YouTube inception here. But if you're looking for our channel, go up into YouTube and just type Oxford Wealth Advisors. Click on that. We have a YouTube channel with tons of good resources, tons of good information. We'd encourage you to subscribe so that you don't miss any of those. We'll be putting this segment up on there. Every one of our market segments, market update segments is on there, as well as our OWA Live, a weekly thing that we do. It just gives you a tidbit. Last one that we did about refinancing your home or holding excess cash, all kinds of good information there. So please give us a like and a subscribe. We'd be happy to continue giving you some good information here. All right, I am all done. So let's move on. There's us again. Thank you for attending. We've got our 1-800 number. I'm guessing, I'm looking through, it looks like we've got folks all over the map on this one. So hopefully you've got our number already. If you don't, there's our 1-800 number. Feel free to give us a call. If you have any questions about style boxes and you want to sit down and discuss that a little bit more with us one-on-one, we would be more than happy to do that. Just give us a call and we can get that scheduled. Okay, we are all done. I'm going to stop the recording here. We'll hang out for additional questions. Thanks again for attending, and we'll see you next market update, the last Friday of September. We'll be picking up again and discussing something else exciting. Thanks, everybody.